Welcome to the SmartKeys podcast. Today, we're undertaking a critical deep dive into a debate that's rapidly moving from just theoretical concern into the day-to-day strategic reality for business leaders. We're talking about the robot tax. And this isn't just about revenue. It's really about how policy can either accelerate or, well, throttle innovation, and that directly impacts your capital spending and how you plan your workforce. The core concept of a robot tax, charging firms a fee when automation replaces human labor, it sounds simple enough. It captures headlines. You've had major public figures, people like Bill Gates, former New York Mayor Bill de Blasio, championing the idea. And usually they have two big aims. One, slow down worker displacement, and two, generate stable payroll revenue for things like social programs.
What's so fascinating here, though, is that the urgency of this whole debate really comes from a massive structural flaw that's already there in how modern economies work, especially in the U.S. If you connect this to the bigger picture, for you, the professional, you realize that current policy is already forcing a choice on you. Our analysis found some really compelling data showing that equipment and software, capital investment, has an effective tax rate of just 5%.
Just 5%.
Right. Now, compare that to human labor. Through payroll taxes and other levies, it faces rates well over 25%.
25% versus 5%. I mean, that's a huge gap. That doesn't just bias investment decisions, it almost mandates them.
Exactly. It's an enormous financial incentive to replace a person with a machine, sometimes regardless of the productivity difference.
So, our mission today is to unpack the hard evidence around this robot tax idea and really analyze the strategic trade-offs. Because designing a policy that gets you revenue without killing growth and competitiveness is, well, it's incredibly difficult. Okay, let's unpack this. And let's start with the most immediate, practical challenge, the definition dilemma. If you, as a business leader, are going to be taxed on a piece of technology, you really need to know exactly what qualifies. Vague policies don't create a level playing field. They just create winners and losers.
And this is exactly where the bureaucracy gets stuck in the details. When you're talking about traditional industrial robots, there's a clear global standard, ISO 8373, that defines a robot as an automatically controlled, reprogrammable, multi-purpose manipulator.
Right, your classic welding arm on an assembly line. Clean, simple, easy to point out in tax.
Exactly.
But so much of modern automation doesn't fit into that kind of mid-20th century box.
Precisely. The complexity just explodes once you step outside that factory cage. I mean, think about software bots or robotic process automation, RPA. That's just code mimicking tasks like accounting or paying bills. Do you tax that?
And if you do, are you stifling efficiency in the services sector, which hasn't seen the same kind of productivity gains as manufacturing?
And then you have all these crucial edge cases, things like driverless forklifts, AGVs in warehouses, or even advanced CNC machines.
And if those edge cases are excluded, it totally changes how businesses compete, right? Can you walk us through that consequence?
Certainly. So imagine a policy designed to slow down automation. If the policymakers decide to exclude, say, driverless forklifts because they don't meet that strict ISO standard, then the entire logistics sector basically gets a free pass.
But the factory next door?
The factory next door, using a traditional welding arm that is ISO compliant, gets hit with the tax. This immediately skews which industries and jobs get penalized. It's a brittle system.
That's a huge structural weakness. So if the policy itself is flawed, it won't work. But let's move from policy design to what's actually happening on the ground. Tax debate aside, what does the evidence really show about automation's impact on jobs and productivity? We found some pretty surprising firm-level findings.
We did. The common fear, is that automation just leads to mass unemployment. But studies from places like Canada, France, and Spain, they tell a much more nuanced story. Firms that adopt automation early, the leaders, they tend to expand their output, they gain market share, and critically, they often hire more workers.
That seems completely counterintuitive. Why would installing thousands of robots lead to more hiring?
It's all about competitiveness and scale. Automation makes the firm more efficient so they can undercut their rivals, grow the whole market, and then they need more people for the things machines can't do yet.
Like maintenance, quality control, customer service.
Or managing the new, more complex supply chain. We found a great example in the U.S. auto sector between 2010 and 2015.
Okay, what happened there?
During that time, the sector installed over 60,000 robots.
60,000? You'd expect jobs to just fall off a cliff.
You would.
Yeah.
But at the same time, the sector added roughly 230,000 employees. The scale of the growth just overwhelmed the replacement effect.
That's a powerful data point. But it doesn't mean everyone is winning, right? This brings us to a really crucial concept. The reallocation effect.
Exactly. This is key to understanding worker displacement today. Automation doesn't just destroy jobs nationwide. It separates the economic winners from the losers. The leading firms, they grow and hire. But their lagging competitors, the less efficient ones. They lose market share, they shrink, and that's where you see sharp, localized job losses.
So the pain isn't technology destroying all work, it's the competitive restructuring of the economy and a failure to help workers transition.
That's the real source of the pain. It's not a failure of innovation.
And we even found examples where technology is designed specifically to complement labor, not just replace it. Tell us about that Japanese example.
The case of Japanese nursing homes is really illuminating. They had severe labor shortages, high staff turnover, so they introduced subsidies for devices designed to assist the human workforce, things like exoskeletons for lifting or automated monitoring systems.
So the goal wasn't replacement.
Not at all. And the result was lower turnover and more capacity for the human nurses. The policy was about subsidizing tech that lifted human productivity. Now, let's pivot to the strategic implications for you, the business leader. If we accept that technology is key to growth, the risk of a robot tax isn't just paying the levy. It's the chance that the tax discourages necessary investment and slows down your long-term competitiveness.
And this really boils down to two core philosophies from our source material: taxing the tools or taxing the outcomes. I mean, if the goal is revenue, why create a whole new complex tax on inputs?
The argument against taxing tools, the robot tax, is pretty compelling. It runs a huge risk of distorting your tech choices, delaying critical purchases.
And even encouraging companies to move their investments offshore to a place without that tax.
Right. Even just the threat of a policy like this can create enough uncertainty to delay big decisions.
And the alternative, which industry groups and even the EU Parliament seem to prefer, is just taxing profits or outcomes. Why is that strategically better?
Because it keeps incentives neutral. If you tax profits, you're taxing the results of efficiency, no matter how it was achieved. If a company uses automation well and becomes more productive, its profits go up, and the corporate tax base just grows naturally.
So you get more revenue without singling out and punishing one specific technology. It's simpler,
Right.
and it doesn't distort investment choices.
Exactly.
Which brings us back to a question that we keep circling. Why invent a really complicated, politically charged robot tax when the U.S. tax code already has this huge structural problem?
That is the critical strategic lesson here.
Yeah.
Like we said, that 5% effective rate on capital versus over 25% on labor, that is the massive incentive driving the shift to machines. Many economists argue that trying to patch this with a narrow, brittle robot tax is just inefficient.
So a broader reform would be better.
A much broader structural reform, yeah. Leveling the field by addressing how all capital is taxed would be simpler, more efficient, and definitely technology neutral. Some analysis suggests that just eliminating that capital bias could lift employment by around 4%.
But wait, if fixing the underlying tax code is the obvious, better solution, why isn't that what policymakers are focused on? Is the robot tax just easier to sell politically?
That's precisely the political angle the sources get into. While fixing the capital bias is economically sound, it's politically really, really hard. It means overhauling entrenched tax provisions. The robot tax offers a quick, emotionally resonant soundbite. We're taxing the machine that took your job. It's visible, it's specific, even if the economic consequences are probably bad.
So for a professional managing capital, understanding that the broader reform is the optimal solution is key.
Okay, that makes sense. Now let's put the tax debate aside for a moment. How do businesses manage the operational and legal risks of these new autonomous systems, tax or no tax? We sometimes hear these proposals about giving AI legal personality. Why does that idea keep coming up, and why is it so problematic?
The idea of giving AI legal personhood comes up because traditional law struggles with non-human actors. But the sources we looked at just dismiss it as bureaucratic and totally unnecessary. I mean, we already tax equipment and property without giving them legal rights. The International Federation of Robotics warns that it would just dramatically slow down innovation.
So if legal personhood is a dead end, what are the practical, non-bureaucratic guardrails a business leader should be focusing on?
You focus accountability on the human owners and operators, not the devices. The approach should be operational, not philosophical. This means using simple, powerful tools, mandatory insurance for autonomous systems, ensuring you have auditable logs of operation for when things go wrong, and just using existing global safety standards.
Exactly, like the ones from ISO TC 299. These tools manage risk, and they assign liability to the person who signs the check the operator. It just makes business sense.
Okay, so manage the technology like any other complex asset. That's clear. Let's turn finally to some actionable worker-first alternatives. If we shouldn't throttle innovation with a tax, what policies actually strengthen business resilience and the workforce?
The key is to shift resources away from fighting automation and toward supporting worker mobility. Policy should fund data-driven reskilling. This means using sophisticated tools to identify small, achievable skill jumps that can move displaced workers into higher-paying roles quickly.
For example.
Well, for instance, helping a construction brick mason, who already has great spatial and motor skills, transition directly to a specialized welder role. It shortens the time between jobs and boosts their income.
That proactive approach is so different from generic, often ineffective retraining programs. What other frictions need to go?
Cutting labor frictions is critical for letting the economy adjust to that reallocation effect. We need policies that ease up on non-competes, which just restrict worker mobility and remove needless occupational certification barriers.
So workers can move more easily between firms and industries.
Right. It lets employment adjust faster to market changes, which is the best defense against long-term career scarring from displacement.
And of course, the smart subsidies that we talked about, like in the Japanese example.
Absolutely. Policy has to target support where machines complement people. That makes human labor more productive and the jobs more appealing.
So what does this all mean for you, our listener? The strategic takeaway seems pretty clear. The most effective policies are the ones that protect worker income and enhance mobility without throttling the capital investment you need for long-term growth. The robot tax debate is really a proxy for a bigger conversation about modernizing a tax system that unfairly penalizes human labor.
And I'd like to leave you with one final provocative thought, especially if you're operating in a global market. Policy design has to be viewed through a global lens. A country that tries to impose a unilateral robot tax risks, creating a huge competitive disadvantage. Firms will just relocate their automation purchases and their investment offshore to avoid the hit.
And in that scenario, you lose both the jobs and the tax revenue.
Exactly. The intended benefits just move to a friendlier jurisdiction.
That point on international coordination really underscores how complex and high stakes this whole thing is. Thank you for joining us for this deep dive into the robot tax debate. Understanding that difference between taxing inputs and taxing outcomes is, well, it's essential for navigating the future of work. We want to explicitly thank you for tuning in to the SmartKeys podcast.
If this discussion has sparked your curiosity about policy design, capital strategy, or workforce efficiency, please subscribe to the SmartKeys podcast for more deep dives into the future of work.
And if you want even more detail on the evidence, including that firm-level data from Canada and Spain, the full article that formed the basis of this discussion is available right now. You can find the link in the show notes.
Stay informed.
And stay ahead.